December 11th, 2008. Inside a sleek office on the 17th floor of a Manhattan skyscraper, one of Wall Street's most respected investors looked at his two sons and quietly admitted something almost impossible to believe. There were no secret trading strategies, no billion-dollar hedge fund, no sophisticated investment program. Instead, Bernie Madoff uttered 8 words that would shock the financial world. It's all one big lie. By the time those words were spoken, more than $65 billion had vanished. Thousands of families would lose their life savings. Charities would disappear overnight. Banks across Europe would collapse. Hollywood celebrities, professional athletes, universities, even Holocaust survivors had unknowingly invested in nothing more than numbers typed onto fake account statements. The unbelievable part? This wasn't a scam that lasted a year or even 5 years. It survived for more than 2 decades. It passed SEC investigations. It fooled billion-dollar banks. It impressed seasoned Wall Street veterans. And one man warned regulators about it repeatedly, only to be ignored. So how did Bernie Madoff convince some of the smartest people in finance to believe in a business that barely existed? The answer wasn't magic. It was psychology, and a system that trusted reputation more than evidence. Long before Bernie Madoff became America's most infamous fraudster, he was Wall Street royalty. His legitimate business started in 1960 with just a few $1,000s. Over the decades, it grew into one of the largest market-making firms on Wall Street. Madoff wasn't pretending to be successful. He actually was. His firm helped execute millions of stock trades. He embraced electronic trading years before competitors. He even served as chairman of the NASDAQ stock market. That title carried enormous weight. If the chairman of NASDAQ couldn't be trusted, who could? His office overlooked Manhattan. His clients included billionaires. His name appeared alongside the biggest institutions in finance. Success breeds trust, and trust became his greatest weapon. Because hidden inside the same building, on a different floor, was an investment advisory business that almost nobody understood. Oddly enough, that mystery made it even more attractive. Bernie Madoff rarely advertised. He didn't beg people to invest. In fact, he often rejected them. Psychologists call this scarcity. People value what seems exclusive. Investors believe they were lucky simply to get access. The strategy supposedly used was called a split-strike conversion. It sounded sophisticated, complicated, safe. Clients were told Madoff carefully balanced stocks and options to generate consistent returns with low risk. There was just one problem. Almost nobody ever verified whether those trades actually happened. Every month, clients received beautiful account statements. Clean, professional, detailed. Each page listed dozens of stock purchases, sales, profits, and balances. Everything looked authentic, except every number had been typed inside Madoff's own office. No independent broker confirmed the trades. No outside custodian held the assets. No third-party auditor verified billions of dollars. The entire investment operation depended on one thing: people believing the paperwork, and they did. For years. Bernie Madoff didn't need thousands of individual investors. He needed a handful of powerful middlemen. These became known as feeder funds. Instead of convincing every wealthy person himself, he convinced investment managers. Those managers then convinced everyone else. Money poured in from around the world. Europe, South America, the Middle East, country clubs, private banks, family offices, Jewish charities, university endowments, retirement accounts. Each feeder fund earned fees for bringing in more investors. That created a dangerous incentive. The more money flowing to Madoff, the more everyone got paid. Few people wanted to ask difficult questions. As long as returns remained steady, everyone benefited. But those returns contained another clue. Markets crashed. Markets boomed. Yet somehow, Bernie Madoff almost never had a bad month. His gains weren't spectacular, usually around 1% each month, just enough to look believable. Too perfect to be real. One man noticed, and he refused to stay quiet. Financial analyst Harry Markopoulos wasn't trying to expose history's biggest Ponzi scheme. He was trying to copy Madoff's strategy. His employer wanted a competing investment product, so Markopoulos examined Madoff's reported returns. Within minutes, he became suspicious, then convinced. Using basic mathematics, he concluded the numbers were impossible. Not unlikely. Impossible. Certain options trades Madoff claimed to make simply didn't exist in large enough quantities. The market volume wasn't there. If Bernie Madoff really executed those trades, the entire options market would have noticed. Markopoulos repeatedly contacted the SEC. He submitted detailed reports, charts, calculations, evidence. Years passed. Nothing happened. The SEC investigated Madoff multiple times. Each investigation ended the same way. No fraud found. Investigators often accepted documents provided directly by Madoff himself. They rarely verified trades independently. One investigator didn't even understand many of the financial instruments involved. The world's largest Ponzi scheme continued growing, not because the evidence was hidden, but because the warnings weren't taken seriously. Investors suddenly needed cash. Instead of sending more money, they wanted their money back. Billions of dollars in redemption requests flooded Madoff's office. In a legitimate investment firm, assets would simply be sold. But Bernie Madoff owned almost nothing. He had been using money from new investors to pay older ones. The classic Ponzi structure had finally run out of fuel. On December 10, 2008, Madoff confessed to his sons. The next morning, they contacted federal authorities. The illusion ended almost instantly. Investigators expected sophisticated trading systems. Instead, they found stacks of paper, old printers, and decades of fabricated records. The fraud had survived not because of brilliant technology, but because almost nobody looked behind the curtain. The Bernie Madoff scandal wasn't just the story of one dishonest man. It was the story of thousands of intelligent people making the same mistake. They trusted reputation over verification. They accepted steady returns because they wanted to believe steady returns existed. Banks trusted feeder funds. Feeder funds trusted Bernie Madoff. Investors trusted everyone else. And regulators trusted paperwork they never independently confirmed. Today, the largest Ponzi scheme in history is remembered for the billions that disappeared. But its most important lesson is far more unsettling. Fraud doesn't always hide in the shadows. Sometimes, it sits in the most prestigious office on Wall Street, wearing the finest suit, with the strongest reputation, waiting for everyone else to stop asking questions. And until next time, thanks for watching. Please, like, share, and subscribe for more Ledger of Lies.